Hi, this is Mark Pizzacalla and welcome to Legalwise, which you need to know with Dr. Mark for August 2024. And what I want to talk about today is buying and selling a business. Now you might say, what's so exciting about that? Well, critical decisions need to be made in terms of buying and selling a business. And what I'm going to focus on today is the selling side of the business. In the next edition, I'll look at the buying side, but on the selling side of the business, there's a few things I want to go through. The list is not exhaustive, okay? So these are just the things that come up time and again. The first thing I want to talk about is capital gains tax and understanding the nuances and understanding the subtleties in relation to capital gains tax is really important when you're buying and selling a business. Now, from the seller side and focusing on shares, do you buy the shares or do you buy the business assets? That's a critical decision that needs to be made. If you're buying the shares, and if you know that the seller is selling the shares and they'd like to sell the shares because they're able to get either a CGT 50% discount or they're able to use the small business concessions to their advantage and pay no tax upon selling the shares, then from a commercial perspective, a negotiation perspective, hey, there's a bit of negotiation that can go on there to try and get the best deal, knowing that the seller wants to sell the shares. Because as we all know, if you buy the shares of a company, you acquire all of the history of the company, and that's not always a good idea. Let me give you an example. Carry forward losses. If you're buying a company with losses, those losses stay in the company. And to access those losses when you buy the company, well, the losses need to be available, they need to be bona fide, and how do you check that? So you need to do a due diligence on the losses. If you're buying all of the shares of the company, you will fail what we call the continuity of ownership test. And that means for you to access those losses once you buy all the shares of the company, you'll need to satisfy the same business test or similar business test, which is a very difficult test to meet because it actually means that the company needs to be conducting roughly the same business in layman's terms. And of course, when you buy a company and you're trying to make changes and you're trying to improve things, you may fall foul of the same business test, similar business test. The other thing too is fixed assets, because the previous company might have taken advantage of generous tax rules which depreciate all of the fixed assets of the company. And where that happens, those assets might not even be on the balance sheet. So you need to probably do a fixed asset audit to make sure that the assets that they are saying are there are in fact really there. Also, you won't be able to depreciate those assets any longer because they will already have been fully depreciated by the company. So that's a downside. In terms of GST, there shouldn't be any GST on the buying and selling of shares because that generally tends to constitute a financial supply. Sometimes people try and use that as a lever, but look, that should be the conclusion there. There's also stamp duty involved. Stamp duty is a state tax, so again, you need to work out A, whether it applies, and B, which state may capture that duty. That's all I'm going to talk about today. Hopefully I've given you some insights, but if you've got any questions, by all means, give me a call. Pay proper attention, pay due care when buying and selling a business. Next time I'm going to talk about buying a business. Look forward to speaking to you then.